All right, let's dive in. If you've ever lived, worked, or even just spent a lot of time in another country, you know that the question of taxes is, well, it's always there. Today, we're going to decode one of the most important concepts for anyone living an international life, tax residency. So, let me ask you something right off the bat. Could you actually be on the hook for taxes in a country where you don't even hold a passport? The answer, you might be surprised to hear, is a huge yes. And we're about to find out exactly how that can happen. Okay, first things first, we have to clear up the single biggest misunderstanding about all of this. Your tax residency has almost nothing to do with your passport or your nationality. It's a completely different ballgame.
So here's the definition you need to remember. Tax residency gives a country the primary right to tax your worldwide income. And that phrase, worldwide income, is everything. It means the salary from your job in Berlin, the rent from a property in Bali, your investments in New York, all of it. The country where you're a tax resident wants to know about it all.
This is where people get tripped up. Citizenship, that's your nationality, the passport you carry. It's usually pretty permanent. But tax residency, that's based on where you actually live your life, where you are, what your connections are, and unlike your citizenship, it can literally change from one year to the next. So how in the world do countries figure this out? While every nation has its own specific rulebook, most of them lean on a pretty similar set of, let's call them core tests, to decide if you're one of theirs for tax purposes.
And that brings us to what a lot of people call the magic number in international tax, 183. If you see this number, your ears should perk up. It's the most common starting point for figuring this all out, and here's what it means.
The first and honestly the most straightforward test is just physical presence. Did you spend 183 days, that's about half the year, in a country? But that's not the only way. You could also be considered a resident if you have a permanent home that's available to you there. And finally, tax authorities are going to look at your center of vital interests. It's a fancy way of asking, where's the heart of your life, both personally and financially? Okay, so those are the general principles, but how do they actually work in the real world? Let's take a quick trip around the globe and see these rules in action. First up, the United States. And we're starting here because it has a truly unique approach that catches a lot of people by surprise. It's not just about where you live. See, the U.S. is one of the only countries in the world with something called citizenship-based taxation. Bottom line, if you are a U.S. citizen, you are taxed on your worldwide income, period. It doesn't matter where you live. For non-citizens, they use something called the substantial presence test. It's a tricky formula that looks at how much time you've spent in the country over the last 3 years. So, take John. He's Canadian, but he worked in New York for 200 days. Boom. He easily passed that substantial presence test. So for that year, the IRS considered him a U.S. tax resident. And guess what? He had to report his entire global income to them. Now, let's hop over to Europe and take a look at Germany, which really shines a spotlight on a different, but just as important factor. Maria's story is the perfect example of that permanent home rule. She's Italian, and maybe she only spent a couple of months in Berlin, but because she was renting an apartment that was available to her year-round, Germany can claim her as a tax resident. It just goes to show it's not always about counting days on a calendar. Next up, let's head to Canada. They take an even more, let's call it a holistic view, looking beyond just counting days to the whole picture of your life.
So look at Ahmed. He might be working abroad for most of the year, but his home, his spouse, his kids, they're all in Canada. The Canada Revenue Agency calls these significant residential ties. And because the core of his personal life is still in Canada, he's still a Canadian tax resident, no matter where in the world his paycheck comes from.
Okay, so you can probably see the problem this creates. With all these different rules flying around, what happens if you accidentally trigger residency in 2 countries at the same time? Do you really have to pay full taxes in both places? Thankfully, no. This is where something called a tax treaty becomes your best friend. Imagine Sophie splits her year perfectly. 6 months in France, 6 in Germany. Both countries could technically claim her. The tax treaty between them has a series of tiebreaker rules. They'll look at things like where her permanent home is or her center of vital interests to decide which one country gets to be her primary tax home. So let's just pull this all together for a second. You've got the US, which is kind of in a league of its own with its citizenship rule. But for most other places, like Germany and Canada, it's a mix of counting days and weighing the strength of your life's connections. And the key thing is, tax treaties act as the referee to sort out any conflicts.
Okay, so we've covered the what and the how, but now for the most important part. Why does any of this actually matter to you? What's the real bottom line here?
Well, the stakes are incredibly high. First, your residency status decides if you're taxed on your worldwide income or just the income you earn from that specific source country. Second, getting this wrong opens up a huge risk of double taxation. And finally, you just can't do any proper tax planning or stay on the right side of the law without knowing where you stand.
Look, if you remember just one thing from our whole chat today, let it be this next point. This really is the core idea that holds all of this together.
Here it is. It is your tax residency, not your citizenship, that gives a country the right to tax your entire global income. And because every country has its own way of doing things, tax treaties are that absolutely critical safety net that stops you from getting taxed on the same money twice. And that leaves us with one final thought. We live in this age of digital nomads and remote work, where you can live in one country and work for a company in another. So how are these residency rules, a lot of them designed decades ago, going to adapt for our increasingly borderless world? That's the big question tax authorities everywhere are trying to figure out right now. Thanks for joining me.